The market is like a giant mood ring, constantly swinging between greed and fear. Fear is that feeling in your stomach when you think something bad might happen. It can make you avoid risks, even if they can lead to good things. Greed, that impatient desire for something, like spending money you should be saving just because you have it and you want that new gadget. It can make you take foolish risks, hoping for a big win, even if it means you lose everything. These emotions play a huge role in investing. Fear can make you miss out on a great opportunity, while greed can make you lose your shirt. Learning to manage them is the key to becoming a successful investor. This episode is brought to you by Stonehill Wealth Management. Money can be stressful, but it doesn't have to be. Our team helps people understand their finances and make smart choices for their future. Let's get into the episode. I can always tell where we are in the market cycle by how people act. When cautious investors suddenly want to gamble on risky assets, it's a sign of greed forming. When aggressive investors become super anxious, it's a sign of fear. And that's human nature. It's why many investors appreciate having someone on their team who can help them navigate these emotional waves and make smart decisions. Greed is back. Right now, I'm sensing we're at the beginning of a greed cycle. It's not full-blown craziness yet, but I can sense it. People are afraid of missing out on this next big trend. So how do you stay grounded when everyone's losing their minds? Here are a few ideas I learned from the great Warren Buffett. You're going to hear me quote Warren Buffett a lot because he's the GOAT, one of my GOATs on the Mount Rushmore of greatest investors, where I put Warren Buffett, Stanley Druckenmiller, Robert Smith, and I got to really think about my fourth one because my fourth one has a lot of good ones, so I won't name that one yet. But those three are for sure up there. I got to get my fourth one on there. But I digress. So how do you stay grounded when everyone's losing their minds? Here are a few lessons. Focus on the long term. Only buy something you'd be happy to hold for 10 years, even if the market crashes. This helps you avoid impulsive decisions and make sure that you really think through what you're investing in. If you have the mindset of, when I put it in there, I got to leave it in there for a decade. It doesn't mean you have to, but you want to get to a point where you are that confident in your investment that you're making. Next idea, be selective. Imagine you only have 20 investment decisions that you can make in your entire life. You'd have to be really careful about the ones you choose because you have a limited punch card. There's no need to rush. It's okay to miss out on some opportunities because there are thousands upon hundreds of thousands of ones that you're going to encounter, and you only got to find a few to get rich. Know your limits. Stick to what you understand. Don't let confidence in one area of your life make you overconfident in another. It's like a great chef trying to perform brain surgery. It's not going to end well. Specifically, there's a lot of people that are good at making money in one aspect of their life, and they try to transfer that confidence to investing without putting in the process of understanding they put in to make money in this area of their life, right? Investing doesn't have to be difficult, but it takes the understanding necessary to become great at it, and there's no shortcut for doing it. You can't just be good at making money over here and just transfer that confidence without the understanding to investing. Let's look at the crypto market for a perfect example. There are over 10,000 cryptocurrencies out there. It can be overwhelming. So I like to like it when you are thinking about embarking on a journey, as Allison, my CPA, that's on here every Friday, talks about, you got to begin with the end in mind, right? So let's talk about the goal, right? So let's say someone has a goal of turning 100,000 into $1 million in 10 years, right? That's their goal. I got 100 grand I can take home run, risks with, and I want to turn into $1 million in 10 years. What this would mean from a return standpoint, that's roughly 26% a year when you do the math. And so it makes you focus on investments that actually are productive or provide a service rather than just betting on things that are going up in price right now. And when you do the math, you realize a 26% a year return is a very realistic goal for a solid asset in a new and growing industry. Think about it. How many companies that started around same time as Amazon are still around today? Or search engines beside Google's? Or social media platforms besides Facebook or Meta? Only the strongest assets survive in the long run. Those winners end up taking most, if not all, the money that was invested into the industry once the weak assets are run out. And that's how investors who back the right companies get rich, by owning a piece of the assets that dominate the new trend. So I take a very focused approach. I limit myself to just a few key ideas in each trend. So let's hone in on crypto, like I mentioned. Here's what I'm currently focused on in the crypto cycle, in the areas I understand and feel are no-brainers from my perspective. Bitcoin. It's the foundation of the crypto world, like the US dollar in the traditional financial system. So meaning, like, if you're betting in the traditional system and you're going, where's the best risk-adjusted returns, right? Well, dollar-based assets are preferred over most other assets in the world because of the U.S.'s competitive reserve status, property rights, all that stuff that makes America attractive to capital. Same thing with the crypto world. Bitcoin is the dollar of that system. It's the most conservative, which makes it the biggest preferred store of value for investors in that space. So next you have Bitcoin-related companies, right? These are the miners, financial service providers, and companies that hold Bitcoin on their balance sheet. That's sort of tied into the bet above of Bitcoin. If Bitcoin does well, the ecosystem around it should do well. Third area I'm looking at is the gateways to crypto. Companies like Coinbase and Robinhood that make money from people buying and selling crypto. So that way you got like 13,000 cryptos out there, something like that. And I'm always researching them, but hey, until they become the big monopoly, I can just make money on a tollway, right? You go up and down the highway by owning companies like Coinbase and Robinhood, I make the money on the tollway, right? And then as I make that money, and one of these other cryptos become a definite dominant player in that space, take those profits, wait for the market to correct, buy in, and make it work. And also, by focusing on these key areas and using things like leverage, options, and concentration, I can boost my returns without having to chase every shiny new crypto that pops up. Which this moves us into money management, right? There are two ways to build a good investment portfolio. The way most people tend to want to build a portfolio is they want to do the equivalent of build a football team by drafting Tom Brady, right? A once-in-a-lifetime quarterback. And while that is possible, it may not be probable, right? If you want to build a sustainable winning team, you want to be able to draft above average players, but you want to put them into a great system. And that's what money management is to investments, right? Most investors want to find, in order to build wealth, they want to find the investment that goes up the most over a period of time, right? Which is only focused on return and not risk in a system. Money management allows you to say, listen, as long as I find the above average asset classes to put in my portfolio, and then I use smart money management, I can make a lot more money than most other investors because I'm good at that. That's what Warren Buffett did, right? If you look at his top holdings, he owned Coca-Cola, American Express, Bank of America, Nebraska Furniture Mart, a bunch of car dealerships, right? Just boring businesses. And he built $1 trillion valuation company by doing that with wise money management. So money management is like being a smart shopper. You set a budget, you make a plan, you track your spending. You don't overspend or put all of your eggs in one basket over the long term. You might put all your eggs in one basket in the short term concentration. That's another episode. But you have a process and a plan. Good money management is less about finding the highest performing asset in a cycle and more about managing your emotions through the cycle once you build your plan. So most people who struggle with money don't have a math problem. They have an emotional problem. They don't know how to balance their desires with their resources. The same is true with investing. By managing your emotions and staying disciplined, you can make smarter decisions and achieve your goals. Make sure you like, subscribe, and hit the notification bell for more insights. Thanks for hanging out. Be fruitful and go multiply your money.
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.